The hardest part of investing isn't picking the right stocks. It's not losing your mind when the green numbers turn red. We've had 2 years of easy mode, 2 years of 40% gain that made us all feel bulletproof. But the market just issued a reality check, and suddenly, everyone's long-term strategy is being tested by a 10% drop. If you're doing panic math on your lunch break, trying to decide if you should move to cash, stay right here. I'm going to show you exactly how to read this volatility and why the move you make in the next 72 hours will determine your net worth for the next decade.
My name is Lewis, and I spend way too much time thinking about portfolio strategy, market cycles, and how to protect wealth while still growing it. If you're someone who's been riding this bull market and you're starting to feel that knot in your stomach, wondering whether the rug is about to get pulled out, make sure to hit the subscribe button to my channel and give this video a thumbs up if this helps you out.
Because today, I'm going to walk you through exactly why I've shifted my portfolio to a more defensive position, the specific data that made me do it, and most importantly, what playing defense actually looks like in practice. Because I promise you, it does not mean selling everything and hiding cash under your mattress. Here's the thing. I am not a doom and gloom guy. If you've watched my videos, you know I'm generally optimistic about long-term investing. I believe in markets. I believe in compounding. I believe in staying the course. But I also believe in math. And right now, the math is telling me to be a little more careful. Let me give you some context. The S&P 500's cyclically adjusted price-to-earnings ratio, that's the CAPE ratio, also called the Shiller PE, has been hovering in the mid to high 30s. To put that in perspective, the long-term historical average, going back to 1871, is around 16 to 17. So we are sitting at roughly double the historical average in terms of how expensive the market is relative to earnings. Now, you might be thinking, Luis, the CAPE ratio has been elevated for years. People who sat on the sidelines because of it missed massive gains. And look, you're absolutely right. Valuation alone is a terrible market timing tool. I'm not using it to time the market. I'm using it to set expectations. And my expectation right now is that future returns from these levels are likely to be lower, potentially significantly lower than what we've experienced recently. Research from Vanguard and other institutions has consistently shown that starting valuations explain roughly 40% of the variance in subsequent 10-year returns. When the CAPE is above 25, the median annualized real return over the next decade drops to somewhere around 3 to 4%. Compare that to the roughly 10% nominal average people love to quote, and you start to see the disconnect between what people expect and what they're mathematically likely to get. This is where it gets really interesting, because the biggest risk right now isn't actually the market itself. It's you. It's me. It's our behavior. There's a concept in behavioral finance called recency bias. It basically means our brains are hardwired to take whatever has happened recently and project it forward indefinitely. The market went up 30%? Cool. Our brain assumes it'll keep going up 30%. And that assumption leads us to take risks we wouldn't normally take. Over-concentrating in high-flying tech stocks, using margin, neglecting diversification. Because everything has been working. So why would we change? Let me give you a real dollar example of why this matters. Say you have a $100,000 portfolio and you're fully aggressive, all equities, heavily weighted in growth stocks. A 30% drawdown, which is completely normal in a bear market, takes you down to $70,000. Now here's the part most people don't realize. To get back to $100,000 from $70,000, you don't need a 30% gain. You need a 43% gain. That's the asymmetry of losses. The math of losing money is fundamentally different from the math of making money, and it always works against you. That single insight is what shifted my thinking. It's not about being bearish. It's about understanding that protecting your downside becomes more important the further into a bull market you go, precisely because you have more to lose. Look, when I say I'm being more defensive, I want to be really clear about what I mean. I am not selling all my stocks. I am not moving to 100% cash. I am not buying gold bars and burying them in my backyard. What I am doing is adjusting my allocation at the margins to reduce risk without abandoning growth. Here's what that looks like in practice. First, I've increased my cash and short-term bond allocation from roughly 5% of my portfolio to about 15%. That might not sound dramatic, but here's why it matters. Cash isn't just a safe asset, it's optionality. If the market drops 20 or 30%, I have dry powder to deploy at lower prices. Think of it like this. Having cash during a market crash is like having an umbrella when it starts raining. Everyone who laughed at you for carrying it around suddenly wants to borrow it. Second, I've been tilting more toward dividend-paying, high-quality value stocks and away from speculative growth names. I still have growth. I still own tech. But I've trimmed positions that were priced for absolute perfection. The kind of stocks where even a slightly disappointing earnings report could send them down 15 or 20% in a single session. Companies with strong free cash flow, reasonable payout ratios, and actual earnings today tend to hold up dramatically better during downturns. Data going back decades shows that high-quality dividend growers have historically captured around 90% of the market's upside, while only experiencing roughly 60 to 70% of the downside. That's a trade-off I'm very comfortable with right now. Third, and this one is underrated, I've been stress testing my portfolio by asking myself one simple question. If the market dropped 40% tomorrow and didn't recover for 3 years, would I be okay? Not emotionally, because nobody's emotionally okay watching that. I mean financially. Could I still pay my bills? Would I be forced to sell at the worst possible time? If the answer to that question is anything other than a confident yes, your portfolio is too aggressive. Here's what most people don't realize about market tops. They don't feel like tops. They feel like the beginning of something even bigger. In late 1999, people weren't scared. They were euphoric. They were quitting jobs to day trade. In 2007, people were buying their third investment property because real estate only goes up. And right now, I'm seeing similar sentiment patterns that concern me. Consumer surveys show that the percentage of households expecting stock prices to increase over the next year has been near record highs. Margin debt has been elevated. The put-to-call ratio, which measures how much protection investors are buying versus how much they're speculating, has been skewing heavily towards speculation. Now, I want to be careful here. None of these indicators are perfect timing signals. The market can stay irrational longer than any of us can stay solvent. That's a lesson history teaches over and over. But when optimism is this widespread and valuations are this stretched, the risk-reward equation tilts. You're not getting compensated for the risk you're taking. And that's the core issue. Let me put a number on it. Say the expected annual return on the S&P 500 from current levels is, optimistically, 6% nominal over the next decade. Meanwhile, you can get 4 to 5% in high-yield savings accounts or short-term treasuries with essentially zero risk. The equity risk premium, the extra return you get for taking on stock market volatility, has been compressed to one of the narrowest spreads we've seen in over 20 years. You're being paid very little extra to take on substantially more risk. That should bother you, even if you're a long-term bull. So let's get tactical. Here are the moves I think make sense right now, regardless of whether the market goes up another 20% or drops 30%. Step 1, know your actual allocation. I'm not kidding. So many people have no idea what they actually own. Open every account, add it all up, and figure out your real exposure. You might discover you're 95% equities because your 401k, your Roth IRA, and your taxable account all own basically the same stuff. That's not diversification. That's the illusion of diversification. Step 2, build your cash cushion to at least 10 to 15% of your investable portfolio. Not your emergency fund. That's separate. This is strategic cash, specifically earmarked for opportunities. Park it in a money market fund or short-term treasury ETF where it's earning yield while you wait. Step 3, rebalance toward quality. Look at every holding and ask yourself, does this company make real money today? Or am I betting on a story? Stories are great during bull markets. They're devastating during corrections. Shift toward companies with strong balance sheets, consistent earnings, and sustainable competitive advantages. Step 4, and this one's more psychological than tactical. Write down your plan. Literally, write it down. If the market drops 20%, I will deploy a third of my cash reserves into broad index funds. If it drops 30%, I will deploy another third. Having a written plan removes emotion from the equation when things get chaotic. And things will get chaotic at some point. That's not a prediction. It's a guarantee. Here's the thing I want to leave you with. Being defensive is not the same as being scared. Being defensive is not being pessimistic. Being defensive means you respect the math, you understand the cycle, and you're positioning yourself to thrive no matter what happens next. The best investors in history, Buffett, Howard Marks, and Seth Klarman, they all share one trait. It's not that they're geniuses at picking stocks, it's that they're exceptional at managing risk when others are ignoring it. The goal right now isn't to maximize every last dollar of upside. The goal is to make sure you're still standing, still invested, and still compounding when the next great buying opportunity arrives. Because it will arrive. It always does. And the people who benefit from it won't be the ones who went all in at the top. It'll be the ones who had a plan, held some dry powder, and kept their heads when everyone else was panicking. That's why I'm more defensive right now. Not because I think the sky is falling, but because I think the umbrella is really, really cheap to carry. And the storm, whenever it comes, tends to arrive faster than anyone expects. If this video helped you think differently about your portfolio, hit that subscribe button. Share this with someone who needs to hear it before they learn this lesson the hard way. And drop a comment below. I want to know, are you adjusting your strategy right now? Fully aggressive. Let's talk about it. I'll see you in the next one.